income statement, and I remember saying that we are going to come back to this question, so you're doing this question now. The nice part about it is that it's already been completed, so don't mind the land and buildings because the land and buildings weren't in this question, but some were completed and it's only the missing parts that we have to fill in, right? Okay, so it states that we must refer to information H and calculate the missing amounts donated by A to C in the incomplete fixed assets. So this is how it looks. So it is the addition at cost for vehicles, disposal at carrying value for equipment, and same for depreciation for the equipment. So information H says the following, right? Depreciation, we remember we read through this. It says depreciation must be written off on equipment at 15% per year using the diminishing balance method. It's very important you know what type of depreciation method it is. Take note that the cost price of this equipment is 18,000 at the beginning of the year, and the carrying value is 12,000 on the first year of the financial year. Same, similar, but then now the carrying amount has accounted for the depreciation, so it's cost minus accumulated depreciation. And we sold it to a director, Tim Lowe, on that 30 September, and 4,000 Rand. No entry has been made of this transaction. So perfect. We can dive into it. What we are calculating here is A, which is addition at cost for the vehicles. Very important you understand, they provide us cost at the beginning of the year and cost at the end of the year. Remember I said these last three, carrying value at the end, cost and accumulated, related to the end. And how do we get to the end? We get the beginning plus during the year to get the end. So here, 780,000 minus 600,000. We have it calculated here. So cost at the end of the year minus cost at the beginning of the year will give us the additions at cost. 780 minus 600K will give us 180,000. So A becomes 180,000. B is the next thing, which becomes disposal at carrying value for the equipment. We have it calculated here. So I have two methods, the long way and the shorter way. The nice part is they already give us what the carrying value is at the beginning of the financial year. So we take the 12,000, right, at the beginning of the year, and then the depreciation for the year we had calculated in the previous video for the income statement. So you go back to that video and we'll see how we got to this amount. Then we take the 12,000 minus the depreciation for the year because we had this vehicle for 9 months, because remember we sold it to a director. So therefore the disposal at carrying value is 10,650. Or the long way could be you have your cost price 18,000, your carrying value. When you subtract these two, you get your accumulated depreciation. Remember I stated that when you have two out of these three, you can calculate the third one. So they give you carrying value and cost. So when you subtract the two, you get your accumulated depreciation. Accumulated depreciation is 6,000 Rand. You take your cost, which is 18,000, sorry, minus 6,000, you get, which is your accumulated depreciation for all the other years, minus the depreciation for the year, and you still get the same amount of 10,650. Depends on how you want to do it, but remember, accounting is only 2 hours, so you have to work smart, not hard. And then the last one that we're looking for is C, which is depreciation. Very important, before I continue with this one, with the income statement video that I'd uploaded a few days ago, I forgot to add that we have to account for the depreciation for the other vehicle that was, or the other equipment, sorry, that was not sold. So remember we said the equipment that was sold had a cost price of 18,000. And then we saw whatever's room, and here is the cost of 280, meaning 280 minus 18,000 is left. You must calculate on the remaining amount. So I made a mistake on that. So just quickly add that part, or I forgot that part. So now when we look at this, we look at the following. So, okay, the depreciation for the disposed equipment was 1,350. That one we got, right? And then we do the old one. So we take the carrying value at old. So remember, to get carrying value, it's cost minus accumulated depreciation. Cost minus accumulated depreciation, we get 210,000 minus the 12,000 Rand for carrying value at the beginning of the year. Then we get 198,000 Rand. Then depreciation for old is that carrying value at the beginning of the year after removing the carrying value of the equipment that we have sold, we have disposed. So it shouldn't be in there. You have to remove it. You no longer own that equipment. So it's times by 15%, you times that by 12 over 12, or you don't even times it at all because 12 over 12 is 1, and you get to 29,700. And when you add these two up, you get 31,050. So this is how your note would look like when it's completed. So the blue amounts are the amounts that we have just filled in. So hope this video did help you. Please don't forget to like, comment, share, and subscribe, and share it. Thank you.